I'm going to tell you something that will fundamentally change how you see money. Something so shocking that when I first learned it, I didn't believe it. I thought it had to be a conspiracy theory. But it's not. It's how the system actually works. Here's the question. Where does money come from? Most people think the government prints it. The Treasury, the Federal Reserve, printing presses churning out bills and coins. And that's partially true. But that's not where most money comes from. Most money, about 97% of all the money that exists, is created by banks. Private banks, like Chase, Bank of America, Wells Fargo. And they don't create it by printing bills. They create it out of thin air. Literally. With keystrokes on a computer. When a bank gives you a loan, they're not lending you someone else's money. They're creating new money that didn't exist 5 seconds ago. And I'm going to prove it to you. By the end of this video, you'll understand how banks create money from nothing. Why your deposit of $1,000 becomes $10,000. In the economy, the one simple trick that makes this possible. Why this system is both brilliant and terrifying. And what happens when people figure out what's really going on. This isn't theory. This isn't speculation. A researcher actually borrowed money from a bank while monitoring their internal systems. To prove this is real. And once you see it, you can't unsee it. Let's start with a very simple question. Think about this for a second. You deposit $1,000 into your checking account at Bank of America, but then Bank of America loans $900 of your deposit to someone else. Let's say Bob needs a car loan. Bob's account now shows $900. He can spend it anytime. It's his money sitting in his account. Wait, do you see what just happened? You have $1,000 in your account. Bob has $900 in his account. That's $1,900 total. But you only deposited $1,000. Where did the extra $900 come from? It was created out of nothing. The bank created it. And here's the really crazy part. Bob takes his $900 and buys a car. The car dealer deposits that $900 into his bank, let's say Chase. Chase now has a $900 deposit. They keep $90 in reserve and loan out $810 to someone else. And that $810 becomes a new deposit somewhere else, which gets loaned out again, and again, and again, and again. That original $1,000 you deposited, it just became $10,000 in the economy. This is where most people's brains break. Mine did. Because this sounds like fraud. It sounds like banks are creating fake money, inflating the money supply, running a scam. In a way, they are. But it's a legal scam. In fact, it's the entire basis of our banking system. It's called fractional reserve banking. And once you understand it, you understand how modern money actually works. Let me show you. Fractional reserve banking means banks only keep a fraction of deposits as reserves. They lend out the rest. Let's walk through exactly how this works step by step. Step 1. You make a deposit. You deposit $1,000 in cash at your bank. Here's what happens on the bank's books. Bank's balance sheet. Assets plus $1,000 cash in vault. Liabilities plus $1,000 they owe you this money. So far, no money has been created. The $1,000 that exists is just changing location from your wallet to the bank's vault. Step 2. The reserve requirement. Now, the Federal Reserve says banks must keep a certain percentage of deposits in reserve. As of March 2020, the Federal Reserve eliminated reserve requirements for U.S. banks. But traditionally, banks operated with requirements of 3 to 10% depending on their size. For this example, let's use 10%, the traditional requirement. So your bank must keep $100 in reserve and can lend out $900. But here's the key. Step 3. The bank makes a loan. Bob comes in and asks for a $900 loan to buy a car. Here's what most people think happens. The bank gives Bob your $900 from your deposit. Wrong. Here's what actually happens. When a bank issues a loan, it creates new money by depositing funds into the borrower's account. Rather than giving loans in the form of currency, the bank creates a new $900 deposit in Bob's account with a keystroke. They literally type $900 into his account. Bank's balance sheet now. Assets, $900. Bob owes them this as a loan. Liabilities plus $900. Bob can withdraw this money. Step 4. The magic moment. Look at what just happened. You have $1,000 in your account that you can spend. Bob has $900 in his account that he can spend. The bank turned $1,000 of actual money into $1,900 of spendable money. Banks individually create money out of nothing when they extend credit. The money is created as fairy dust produced by the banks. The $900 is new money. It didn't exist before. The bank created it. And this is completely legal. This is how banking works. Step 5. The multiplier effect. But it doesn't stop there. Bob uses his $900 to buy a car from a dealer. The dealer deposits that $900 into his bank. Let's say Chase. Chase now has $900 in new deposits. They keep $90 in reserve, 10%, and can lend out $810. That $810 becomes a new loan to someone else, creating another $810 in new money. That person spends it. It gets deposited, 10% is kept, 90% is loaned out. This continues until the original $1,000 has been multiplied throughout the entire system. The money multiplier formula. The amount of money that can be created is determined by the money multiplier, which is calculated as 1 divided by the reserve ratio with a 10% reserve requirement. Money multiplier equals 1 divided by 0.10, which equals 10. So, $1,000 becomes $10,000 in total money supply. Original deposit, $1,000. After first loan, $1,900. Your $1,000 plus Bob's $900. After second loan, $2,710 plus $810. After third loan, $3,439 plus $729. Continuing final total, $10,000. The amount of base money, physical currency, remains the same at $1,000. $1,000 of real money became $10,000 of bank money, and 90% of that money, $9,000, was created by banks out of thin air. So, how did we end up with a system where banks can create money? It started as an accident, a scam. Really, but it worked so well, it became the foundation of modern banking. In the past, people deposited gold and silver at goldsmiths for safekeeping, receiving notes in exchange. These notes gained acceptance as money and were used directly in trade. Let's say you're a goldsmith in 17th century London. People bring you their gold for safekeeping. You store it in your vault and give them a receipt. Pretty soon, people start using your receipts as money instead of withdrawing gold to buy something. They just hand over the receipt. The receipt becomes as good as gold. Then one day, you notice something. Not everyone comes to collect their gold at the same time. In fact, on any given day, only about 10% of people want their gold back. So you think, why is 90% of this gold just sitting here doing nothing? I could lend it out and charge interest. Goldsmiths observed that people would not usually redeem all their notes at the same time, and they saw the opportunity to invest their coin reserves in interest-bearing loans and bills. So, you start issuing loans. You give someone a receipt for gold you don't actually have. You're creating fake receipts, but it works, as long as not everyone comes at once. You can keep lending out gold that doesn't exist and collecting interest. But then one day, a rumor spreads, the goldsmith doesn't have all the gold. Everyone runs to redeem their receipts at the same time. This is called the bank run. And you can't pay everyone because you only have 10% of the gold you promised. You're ruined. Bank runs and panics in the late 1800s and early 1900s exposed the inherent risk in fractional reserve banking. After the Great Depression, when thousands of banks failed, governments said, "We need to regulate this," so they created reserve requirements, meaning banks must keep a minimum percentage. They created central banks to act as lender of last resort, and they created deposit insurance, where the FDIC guarantees deposits up to $150,000. The emergence of central banks reduced the risk of bank runs and allowed fractional reserve banking to continue as the prevailing system worldwide. This made fractional reserve banking safe, or at least safer than before. But here's what they didn't change. Banks still create money out of nothing. Now, at this point, you might still be skeptical. This sounds like a conspiracy theory. Surely banks can't just create money. There must be more to it. I felt the same way. So, let me show you the proof. In 2014, a researcher conducted an empirical test by borrowing money from a cooperating bank while monitoring its internal records to establish whether the bank transferred funds from other accounts or created new money. An economist named Richard Werner actually borrowed money from a bank, Raiffeisen Bank in Germany, while watching their internal systems in real time. He watched what happened when the loan was issued. 3 theories were being tested. Theory 1, financial intermediation. Banks just move money from savers to borrowers like a middleman. Theory 2, fractional reserve. Individual banks move money around, but collectively the system creates money. Theory 3, credit creation. Each individual bank creates money from nothing when issuing loans. The study established for the first time empirically that banks individually create money out of nothing. The money is created as fairy dust produced by the banks individually when the loan was issued. The bank did not transfer money from other depositors. It did not move money from the central bank. It did not take money from anywhere else. They simply created a new deposit in the borrowers. Account keystroke. Done. New money existed where none existed before. This wasn't theoretical. This was watched happening in real time. Banks create money out of nothing when they make loans. That's the system. That's how it works. Okay, so banks create money. So what? Why does this matter to you? Because it explains everything about how the economy works and why it feels broken. Think about what we just learned. Every time a bank makes a loan, new money is created. The vast majority of money in the economy comes from loans created by banks. More money chasing the same amount of goods equals inflation. Your dollar loses value not just because the government prints money. It loses value because banks create trillions in new loans every year. Between 2000 and 2024, the empty money supply, which includes bank deposits, increased from $4.9 trillion to over $21 trillion. Most of that wasn't printed. It was created by banks making loans. Here's something wild. When a loan is repaid, that money disappears from the economy until the bank issues another loan. Money is created through loans. Money is destroyed when loans are repaid, which means for money to exist, someone must be in debt. If everyone paid off all their debts tomorrow, there would be almost no money in the economy. The system would collapse. Our entire monetary system requires perpetual debt. The Federal Reserve gets all the attention: interest rates, monetary policy, Jerome Powell on CNBC. But banks create 97% of the money supply through lending. When banks get scared and stop lending, like in 2008, the money supply contracts. Recession. When banks lend aggressively, like 2005 to 2007, the money supply explodes. Bubble. Banks, not the government, control the money supply. Private corporations control the creation of money. Here's the mathematical problem. Banks create the principal of loans, but not the interest. You borrow $100,000 at 5% interest. The bank creates $100,000, but you owe $105,000. Where does that extra $5,000 come from? It doesn't exist yet. Someone else needs to borrow it into existence, which means the system must continuously expand. There must always be more loans, more debt, more growth. If growth stops, the system collapses. Remember, when you deposit money, it becomes the bank's property. Your account shows $10,000, but that's just the bank's promise to pay you. If the bank fails, your deposit is gone. Yes, FDIC insurance covers up to $150,000. But the FDIC only has about 1.3% of total insured deposits in its fund. If several major banks failed simultaneously, FDIC couldn't cover everyone. As of March 26, 2020, the Federal Reserve no longer requires U.S. banks to keep money in reserve. For transactional accounts, that means your bank might have 0% reserves. Your entire deposit could be loaned out. They're gambling with your money, and the system only works if you don't all ask for it back at the same time. So what happens when people understand the system? History shows us. In 2008, people realized banks have been creating money and lending it for terrible mortgages. When those loans started defaulting, banks became insolvent. Bank runs were starting. Northern Rock in the UK had lines around the block. Washington Mutual, Wachovia, others were collapsing. The government stepped in with TARP $700 billion bailout to prevent total collapse. But think about what that revealed. The entire system was on the edge. If people had all tried to withdraw their deposits, the banks couldn't have paid them. The money didn't exist and had been created through loans that were now worthless. In 2020, when COVID hit, the Fed and banks created more money than any time in history. Empty money supply increased by $6 trillion in 2 years. Banks made trillions in new loans. The government sent stimulus checks. Where did all that money come from? It was created out of nothing. And now we have 8% inflation at its peak because there's too much money chasing a few goods. Here's what worries me. This system works as long as people trust it. As long as people don't all try to get their money at once. But trust is fragile. In 2023, Silicon Valley Bank collapsed in 48 hours. Why? Depositors lost confidence and tried to withdraw. The bank didn't have the money. It evaporated. That can happen to any bank because the money doesn't exist. It's just numbers in a computer, backed by loans, backed by promises. If confidence breaks through inflation, crisis, cyber attack, whatever, and people rush to withdraw, the system can't handle it. And then we find out what money really is, collective belief, when the belief ends. So let me bring this back to where we started. Where does money come from? Now, banks create it out of nothing, through loans, using fractional reserves. 97% of money is created this way. Only 3% is physical cash printed by the government. Money isn't real in the way you thought it was. It's not backed by gold. It's not even backed by government assets. It's backed by debt, by promises, by the collective agreement to pretend these numbers mean something.